Jake buys a rental property. Marcus puts the exact same money into index funds. They both think they're making the smarter choice. And they're both wrong. Why? Because one of them forgot to count the hours, and the other forgot to count the zeros. Run the numbers over 20 years, and the difference will make your stomach drop. Let's keep this fair. Jake and Marcus start in the same place. $50,000 saved. $55,000 annual income. Same age, same city, same financial starting point. The only difference? What they do with that $50,000. Jake uses it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a solid neighborhood. Jake takes out a 30-year mortgage at 7% interest. His monthly payment? About $1,330. He finds a tenant willing to pay $1,800 a month. On paper, that's $470 in profit. Before he even spends a single dollar on maintenance, taxes, or repairs, Jake feels like a genius. Marcus takes the same $50,000 and invests it in a total stock market index fund. No leverage, no tenants, no keys to hand over. He sets up an automatic $300 monthly contribution and walks away. CO workers ask what he's investing in. Index funds, he says. They nod politely and move on. Day 1, Jake has a house, a tenant, a story to tell at dinner parties. Marcus has a brokerage account, a confirmation email. Not even close in terms of how it feels. But here's the kicker: feelings and math are two very different things. For the first few years, Jake is living the landlord dream, collecting rent, watching the house appreciate, and feeling like a pro investor. Rent checks hit Jake's account on the 1st of every month. He drives past the property on the way to work and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes, shaving thousands off his bill each year. Every mortgage payment builds equity. He watches comparable homes in the neighborhood tick up in value. Everything about this investment feels real, tangible, and smart. Marcus? He logs into his brokerage account once a quarter. The number goes up a little, down a little, then up again. Year 1, $50,000, $55,000. Year 2, maybe $61,000. It doesn't feel like anything is happening. No keys in his pocket, no tenants texting him, no property he can point to from his car window, just a number on a screen. Jake's friends ask about his property. Marcus's friends, they don't ask about anything. The social proof alone makes Jake feel like he's winning. By a mile. Now, let's see what happens when we look at the numbers through year 3. By the end of 3 years, Jake has collected roughly $64,800 in rent. His mortgage payments total about $47,880, leaving $16,920 in gross cash flow. Sounds great, until you start subtracting the real costs. Property taxes, approximately $3,000 per year. Insurance, approximately $1,500 per year. Replaced a water heater, $1,200. Fixed a leaking roof, $2,800. 1 month of vacancy, $1,800 lost rent plus $600 to clean and relist. And then there's property management. Jake does it himself to save money. So that means phone calls at 10 p.m., weekend showings, coordinating repairs during lunch breaks. After all real expenses, Jake's net cash flow over 3 years, somewhere between $2,000 and $4,000. Not the $16,920 that looked so good on paper, and that doesn't even account for a single hour of his time. Meanwhile, Marcus? He's invested the same $50,000 into a total stock market index fund, added $300 per month for 3 years, roughly $10,800 in contributions. Assuming a 10% average annual return, his portfolio is sitting at about $76,000. No tenants, no repairs, no midnight phone calls, 0 hours of management. And that's the moment you realize, sometimes, the hands-on feeling of winning can be completely deceptive. 0 phone calls, 0 emergencies, But Jake still has leverage working for him. That $250,000 property? It's been appreciating about 3 to 4% per year, and now it's worth roughly $270,000 to $280,000. His equity, the difference between what the house is worth and what he owes, has grown to about $55,000 to $65,000. That's real wealth. And a big part of it comes from using the bank's money. That's the power of leverage. And it's the one advantage stock investors can't easily replicate. Meanwhile, everyone talks about the rent check. It's the number on YouTube thumbnails. It's the brag at real estate meetups. It's the figure your landlord buddy drops at the barbecue. But what nobody talks about is everything that comes out of that rent check before you actually keep any of it. Vacancy, repairs, insurance, property taxes, maintenance, management. All those invisible costs that turn the glossy number into reality. The average rental property sits empty for about 1 month per year. That's not a disaster, but it's one full mortgage payment with zero income to cover it. And when a tenant moves out, you're paying for cleaning, minor repairs, listing fees, your own time to screen and show the property. Then there's maintenance and repairs. A good rule of thumb: budget 1 to 2% of the property's value per year. On a $250,000 house, that's $2,500 to $5,000 annually. Some years, it's just a $200 faucet fix. Other years, it's a $7,000 HVAC replacement you didn't see coming. Right in August, when your tenant is threatening to leave. And don't forget capital expenditures. Roofs, for example, last 20 to 25 years, but when they go, you pay big, and you can't postpone it. Furnaces last 15 to 20 years. Water heaters last 10 to 12 years. These aren't optional. They're guaranteed future costs. And they come in chunks of $5,000 to $15,000. If you're not setting aside money every month for these, you're not running a business. You're running on luck. Then there's property management. Hire a manager. That's 8 to 10% of monthly rent, gone immediately. About $150 to $180 per month. Manage it yourself. You're basically working a part-time job you don't get paid for. Either way, it costs something. And now, the risk nobody likes to talk about: bad tenants. A tenant who stops paying rent and knows the eviction process. That can cost you 3 to 6 months of lost rent, plus legal fees. One single event like that can erase an entire year's profit, or more. None of this shows up in the $470 per month cash flow number. But it all adds up. Eventually, it catches up to you. By year 5, Jake is deep in the reality of being a landlord. He's on his 3rd tenant. He's replaced the roof for $8,500, dealt with a plumbing emergency, costing $1,400. Spent 1 month vacant between tenants. He raised the rent to $1,950, which helps, but property taxes and insurance have also gone up. His actual cash-on-cash return, the money he actually pockets compared to what he put in, is hovering around 3 to 5% after all real expenses. Not bad. But nowhere near the 15 to 20% return he bragged about at the barbecue. Meanwhile, Marcus is still doing absolutely nothing. His portfolio, it's grown from $50,000 to roughly $135,000 to $150,000 by year 7, including all his $300 monthly contributions. He didn't pick individual stocks. He didn't try to time the market. He didn't lift a finger. And now, the power of compound growth is starting to accelerate. Now Marcus is starting to feel the magic of compounding. The gains on his gains are generating more new wealth each year than his original contributions ever did. Here's what's happening. Jake's wealth is growing too, but slowly, after expenses, and it requires constant attention. Marcus's wealth, on the other hand, is following a curve. Slow at first, then faster and faster. Compounding is boring for the first 5 years, and astonishing for the next 15. By year 10, Jake's property is worth roughly $335,000 to $350,000. Remaining mortgage balance, about $166,000. That puts his equity at approximately $170,000 to $184,000 over 10 years, after every real cost: mortgage interest, taxes, insurance, repairs, vacancy, and capital expenditures. Jake's total out-of-pocket beyond the original down payment is somewhere between $20,000 and $35,000. Marcus's portfolio, with consistent $300 monthly contributions and roughly 10% average annual returns, is sitting at around $165,000 to $180,000. He put in $50,000 up front, plus $36,000 in contributions, $86,000 total. The rest? Pure compound growth. And he spent 0 weekends fixing anything. At year 10, the numbers are surprisingly close. Jake might be slightly ahead thanks to leverage, but here's the catch. Jake has spent hundreds of hours managing his property, taken on hundreds of thousands in debt, and concentrated his entire investment in a single asset, in a single zip code. Marcus? He's diversified across thousands of companies, earning comparable wealth without losing a single night of sleep. And this is where the story really separates. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is either paid off or nearly there. His equity sits between $400,000 and $500,000, depending on appreciation. He's collected rent the entire time, but after 20 years of maintenance, repairs, tenant turnover, taxes, insurance, and at least one major renovation, Jake's total net cash profit from rent is somewhere around $40,000 to $80,000 above what he spent, maybe more in a hot market, maybe less in a flat one. Marcus's portfolio, assuming 10% average annual return with $300 monthly contributions, has grown to roughly $420,000 to $460,000 over 20 years. He started with $50,000 and added a total of $122,000 in contributions, the other $300,000 plus. That's pure compounding. No debt, no tenants, no 2 a.m. phone calls about a broken pipe. When you compare net worth, Jake and Marcus end up in roughly the same ballpark, between $400,000 and $500,000 each. But how they got there? Completely different stories. Jake worked for it. Stress, concentrated risk, illiquidity. Marcus waited for it. Experienced volatility, yes, but with freedom and liquidity. And here's the part that changes the math dramatically. If Marcus increased his monthly contribution by just $200, bringing it to $500 a month, his 20-year portfolio jumps to roughly $550,000 to $600,000. That's the magic of the stock market. Increase your contributions, and compounding multiplies the effect over decades. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. But I'm not just here to bash real estate. Stocks have risks too, risks most influencers love to gloss over. Volatility is brutal. In 2008, the market dropped roughly 37%. In March 2020, it dropped 34% in a single month. If Marcus had $150,000 invested at the time and watched it fall to $95,000 in a few weeks, that's not just a number on a screen. That's gut-wrenching. And the data is clear. Most retail investors panic sell during crashes, then buy back after the recovery, locking in losses at the worst possible time. There's also no real cash flow in index funds. Unlike a rental property, your investments don't send you a monthly check you can spend. Dividends exist. But on a total market fund, you're looking at maybe 1.5 to 2 equal yield. On $150,000, that's about $200 per month. Not enough to replace anyone's income. No leverage. Marcus used $50,000 to control $50,000 in assets. No mortgages, no tenants, no 2 a.m. emergencies. Jake used $50,000 to control $250,000 in assets. That 5-to-1 leverage is powerful when property values rise, and it's the main reason real estate creates more millionaires than the stock market in many surveys. And there's tax magic too. Depreciation. Real estate investors can deduct the theoretical decline in their building's value from taxable income, even if the property is actually appreciating, a legal tax shelter that stock investors simply don't have access to. Real estate wins in specific, identifiable situations. When the rent-to-price ratio is strong, monthly rent is at least 0.8 to 1% of the purchase price. When you're willing to treat it like a business, not a side hustle, screening tenants carefully, budgeting for capital expenditures, and building efficient systems. In these scenarios, returns can exceed stocks, especially when you use leverage. And with strategies like house hacking, living in one unit and renting the others, you can reduce your own housing costs to near zero while building equity. That's something the stock market simply can't do. And here's another advantage for real estate investors. If you understand 1031 exchanges, you can defer capital gains taxes by rolling profits into a new property. That lets you grow a real estate portfolio tax-free in ways stock investors can't replicate outside retirement accounts. Real estate isn't a bad investment. It's misunderstood. Jake and Marcus both walked away thinking they made the smart choice. Jake believed real estate was the proven path to wealth. Marcus believed the stock market would do the work for him. But neither of them actually sat down and mapped out the full costs, in dollars, time, stress, and risk. Over 10 or 20 years, the real trap isn't real estate. And it isn't stocks. The real trap is choosing one based on a YouTube headline, a podcast clip, or something your uncle said at Thanksgiving, without running the full numbers for yourself. And if you're wondering about doing both, owning property and investing in the market at the same time, that's a whole other conversation. The math there, it could change everything you think you know. For now, the next time someone tells you real estate always wins, or the stock market always wins, ask them one simple question. Did you include everything? Because the answer that includes everything is the only one that truly matters. If you like this video, please like, share, and subscribe to our channel. See you in the next video. Thanks for watching.